Welcome to Age, Pension, Super and Retirement. I am your host Yvonne, and as always, this podcast is information only and not personal advice. In today's episode, we are going to look at safe withdrawal rates. To do so, I would like to welcome back the Director of Prosperity Planning Partners, Gayle McHugh.
Hello, lovely to be with you.
It certainly is, Gayle. Gayle, could you explain what safe withdrawal rates for superannuation is actually all about?
Well, it's pretty much like the law of averages, because some years we will have the markets perform positively, some years we will have the markets perform negatively. It's also going to depend on how your portfolio is structured, but overall, the safe withdrawal rate is considered to be approximately 4% per annum of your initial balance. So let's say you've got, for simplicity, $100,000 in super. Your safe drawdown rate, because cash should provide you, if you are fully in cash on current interest rates, you should be getting 4%. That would be a safe drawdown rate. But, I say but, there are times if you have a portfolio that is structured to include a range of growth assets, your portfolio value may fall and that 4% may actually appear to be unsafe from an emotional perspective, because your portfolio may have dropped by 10 or 20%. So instead of having $100,000 there, you might have $90,000 or even $80,000 there. And if you're taking $4,000 a year out of that 90 or 80, from an emotional perspective, that does feel unsafe.
I love that distinction from the emotional perspective. Gayle, could you go through the required percentages to draw down superannuation by age?
Well, in the current 25-26 tax year, it depends on effectively the starting balance of your portfolio at the time of implementation of your income stream. So they say 4% while you're under 65. From 65 to 74, it's currently 5%. From 75 to 79, it is 6%. And then from 80 to 84, it's 7%. Now, it does go much higher than that. I do have one client that has a drawdown rate of 13% per annum. But the reason behind these government minimums of drawdowns, it's not that you are going to be necessarily earning those percentages. It's actually a requirement for you to draw down that percentage from your portfolio to maintain the tax-free status in retirement. If you fail to do that, effectively, as in take down the minimum payment, effectively your pension fails the test of being a pension, and you run the risk of having your account converted back to an accumulation account, so you pay 15% tax on it.
That's really helpful, Gayle. Just to go off on a tangent question without notice here, Gayle, if someone was to go into pension phase, say 1st of July coming, how long have they got to draw that percentage down? Like, do they have the whole of the financial year?
Yes, they do. So you could choose to take a fortnightly payment, a monthly payment, a quarterly payment, a semi-annual payment, or an annual payment that covers that minimum drawdown. Now, when I mentioned the failure to meet your usual minimum drawdown, that's very rarely going to happen in anything other than a self-managed super fund. It won't happen in, say, an industry super fund or a retail super fund, because they set the minimum payment for you, and that is the default payment, unless you and your advisor nominate to take higher. Self-managed super funds are different because they have a different way of doing their annual reporting. They don't all have to do it as at it all has to be done as at 30th of June, but they can take up until October in any given year or later to come up with what their account balance was as at the 30th of June. So therefore, they might, I've got a self-managed super fund, and if I was in pension phase, I would be taking the minimum out based on what I knew my previous financial year's balance was, and then as soon as the member balance came through, I would then do an adjustment to make sure that I met that minimum payment. Because if you don't, as I mentioned, in a self-managed super fund, and you don't meet that minimum pension drawdown, you actually kick your fund back into your account in that fund, back into accumulation phase.
That's really interesting. And just to double down on this, if someone went into pension phase in the new financial year, is the percent based on their balance as of the end of the last financial year, or is it floating?
It depends on when they start. So if they start, say, in June, you don't actually have to take a payment for that year. You can defer the payment into the next year because you're not going to be able to meet the minimum, because minimums are worked out on a pro rata basis. So let's say, back to my $100,000 in payment phase, we're taking 4% out, $4,000. My brain's not going to work this out very well. So let's say it's $350 would be about the amount, would be a monthly minimum payment on a $4,000 pension if you started in July. But if you start in June, you actually don't have to take the whole 4%. You would only have to take potentially $350 because it's worked out on a pro rata basis over the year based on the time in the year that you started your pension.
That's super helpful, Gayle. Thank you. Gayle, could you touch on the psychology of running out of money and perhaps transferring that risk to an annuity?
Oh, now this is a really, really interesting conversation because most people you see in our group go, oh my God, my advisor said I should put money into an annuity. There's pluses and minuses to that. So the psychology of it is partially that people will run out of money, but partially that they don't understand that the advisor is trying to do two things. One is to smooth an income stream, because we can work with the annuity provider to say, give these clients money every month, every quarter, every 6 months, or annually, whatever works for their budget. And that helps transfer cash flow risk, but it also means that because if this is a lifetime annuity, Centrelink will give you concessions on the amount of income and asset that they assess. It could actually see an increase in an age pension entitlement. So effectively, the trade-off there is, yes, I am giving up access to my capital and transferring it to an annuity provider, but the government is likely to give you more fortnightly in your age pension entitlement. You're going to be getting effectively another stream of income that can be considered to be tax-free, and it is also concessionally tested. So for some people, the psychology is, oh my God, I'm giving up my capital. And for others, it's like, oh, I'm giving up my capital, but I'm going to get more from Centrelink. I'm going to have this standard amount drop into my account every month. My cash flow is going to be secure. Oh, I can breathe easier. So it depends on which side of the fence that you sit as to whether you see an annuity as a great opportunity or not.
Yeah, that's very well put, Gayle. And I guess the longevity risk is basically taken over by an annuity for someone who's got the genes to live to an old age.
Oh, yeah, my goodness. I've got a client that they came to me about 13 years ago, just after I started my practice, and they had previously had an advisor that they'd had a bit of a falling out with. But having said that, that advisor did something amazing for them. And that was way back then, they put in place an annuity that was, in the old days, there was 100% asset test free annuities and 50% asset test free annuities that were available to be put in place depending upon when they were placed. And this client has still got, and she's well into her 80s, I think she's 87 now. They put it in place when she was 65. She has had about 7 times more income from that income stream than the original capital investment.
Wow.
So, yay for her.
Yeah, exactly.
The actuaries at the annuity provider are probably going mumble, 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 mumble. She's outlived our expectations. But this is one of the advantages of having a lifetime annuity, that if you live past average life expectancies, that transfer of longevity risk is actually beneficial to the annuant rather than the provider.
So interesting, Gayle. So, Gayle, When people are trying to preserve their wealth, but they can't put money back into superannuation, you did mention some of the withdrawal rates get quite high there. Do people just invest excess funds in their own name?
Generally, yes. And I say generally, yes. And sometimes we actually use an annuity because of the concessional assessment treatments that are there. Because the new annuities that are out there have a guarantee period on them that if you put it in place, you're guaranteed to get a partial return of capital to your estate. Those 100% asset test and 50% asset test free ones were like if you put it in today and you got run over by a bus tomorrow, the annuity provider went, yeehaw, thank you, and your estate got nothing. Whereas the current crop of annuities that are out there generally have a guarantee period that your money will come back to your estate or a portion of your money.
I think you're right. I think people have a memory of how it was.
Yeah, it does. But then if we're not using an annuity, I've got a lovely client. She is, God love her, she's well into her 90s, and I work with her son and daughter who are her EPOAs. We have in place a specialised aged care based annuity, an income stream from a downsizer contribution that provide really good tax effective income. She's also receiving a DVA entitlement. So because of her type of entitlement, that can't really be changed. She doesn't lose it based on asset. We've also got a portion of the surplus amount that we couldn't put into those two investments in growth assets. And last year, the lovely lady ended up with a tax refund because of the way we have her assets invested. So yes, they do put them back into their own name. They do put them into what we would call ordinary money investments, or sometimes into an annuity.
What did that word mean, that phrase, ordinary money investments? I haven't heard that.
Oh, haven't I dropped that into our conversations before? Oh, okay. So everyone talks about super. So super is a tax structure. It has lots of concessions available to people at different ages and different stages. Whereas ordinary money investments are something that includes your bank accounts, shares, managed funds, exchange traded funds that are held in your own name or jointly with somebody else that are not within the superannuation environment.
That makes sense, Gayle. Totally understand that now. Now, I understand that superannuation is not meant to be a vehicle for intergenerational wealth transfer, but do you find many are leaving large superannuation balances behind?
That's a yes and a maybe, because it depends on the size of the superannuation balance to start with. It also depends on the asset allocation and the risk profile of the investor, because I've got clients who have started their investment journey, their retirement journey with me years ago, and they've still got more than they originally put in. They're drawing down more because cost of living has gone up, their balance has gone up, they've got that minimum drawdown that they have to meet. But some of them are looking at it going, oh, I've got to save money for aged care where in case something happens. Others are going, I'm just going to spend it and the kids are going to have nothing left. Others are just going to go, you know what, I'm going to give my money to my kids now so I can see them enjoy it. So there is a bit of an intergenerational wealth transfer thing going on. But in a lot of instances, what we're seeing now is that it's not necessarily from superannuation. It's from somebody who bought a house back in the 50s and the 60s, and it's now worth multiple millions of dollars, and their kids get that. They might have paid, $4,000 for a house back in the 60s. I say dollars because that was after 66 when they came into the decimal currency came into being. Before that, it was pounds. I think my in-laws paid £3,000 for their house in Sydney way back when. This is where money has been made. It hasn't been made necessarily in superannuation because superannuation didn't become compulsory until the 90s, whereas home ownership in Australia has always been a love affair for people. So it's like, got to buy a house.
Such a great answer, Gayle. And you touched on it just before. Do you think now that aged care is a major reason for perhaps people oversaving?
No, I don't think it's so much oversaving. I think what you're finding right now is people are spending to meet their needs, but the oversave is actually being forced by the fact that they have a home. So you think back to it. I remember buying our very first house back in 1982. We paid $50,000. Now, at the time, people were like, "You're spending that much on a house. What do you think you're doing?" I remember my grandfather, when we bought another one of our houses, I said to Mum, just don't tell him that we've got bridging finance going on, because we found the house, we fell in love with the house. Our other house was all but paid off. He had massive bridging finance. I said, don't tell him, because he won't sleep. Because when my grandfather built his house in the 70s, just as they were ready to retire, he had to borrow $3,000 to finish it. And he didn't sleep till that $3,000 was paid off. So I don't understand how people who have got a property that they've had for some time haven't seen some degree of appreciation in value. I know I've got clients who spent $300,000 on a property and it's now worth around $700,000. And that's not on the Gold Coast, that's out around Ipswich. And therefore, without them trying, their wealth has increased.
I see what you're saying, Gayle, and we talk about it more in other episodes, but the family home, when it's no longer protected, is what you're saying is that can be tapped into or used for the aged care.
100%. And right now, the number, it's around $214,885, because I looked it up for something yesterday, that the house is sheltered at if you aren't able to live in it for up to the first 2 years of entry to care. But then after that, it's actually assessed at market value. Now, I know that sounds weird to have two different attitudes, but if you've got a house that's worth $2 million and it's only being assessed at $214,000, it doesn't encourage families to rush to sell the property.
No, but as you're saying, after a time period goes by, that $2 million property will mean they'll pay a lot themselves now for aged care.
And they will also lose their age pension, because that property is no longer sheltered as a family home. It's now a fully accessible asset, and you can't have that sort of asset sitting there and retain an age pension.
Yes, I think this is an unwelcome shock to a lot of people.
Well, we also have to stop and think about this from the perspective of Australia has a housing shortage right now. Australia has an aged care bed placement shortage. You can't really expect the government to be paying, and they do contribute quite significantly to cost of care, even though we, the users, are paying, to be paying for all of the costs associated with having somebody in care that the government's liable for, and then have this house sitting over there empty and not available to the housing pool. There's a significant shortfall. So I can understand why the government has said after 2 years, we're giving you up to 2 years to get your act together, to clear the house out, to come to terms with stuff emotionally, and to start to plan with clarity and effectiveness what we need to do to start to now pay for the full cost of care that the government has been excessively subsidising. I know it's harsh, but it's reality.
Such a great comment, Gayle. It's always good to go broad when talking
and sometimes
to you.
people go, oh my God, why do you think about that? But I have to think about it from the perspective of, I sit in so many fund manager briefings and they're saying, well, we can't build enough infrastructure and housing for multiple reasons. And part of it is there is not the trade, as in the tradie, the brickie, the electrician, the plumber. There's not enough of them around right now to cope with the volume of work. And I personally have just done a renovation at my house, and we had a tiler, actually not one tiler, but 5 tilers cancel on the builder.
What was that all about?
Well, the job either wasn't big enough because it was only an ensuite, or they couldn't get enough money for it, or they had another job came up that was going to be more lucrative to them, and went, oh, hang on, I can make 2 or 3 times more on this bigger job than I can on that one. I'm just going to let the builder down. He's going to annoy the homeowner. And, that's the way we're going to do it.
Yes.
And I was like, okay, so this is what happens.
That's the reality. Gayle, how can you be reached?
You can call me on 0407 159 298, or you can email me at Gayle, Gayle, at prosperityplanning.com.au.
Thanks so much, Gayle. Now, to finish up, could you talk about how the age pension is the safety net for those concerned about running out of money?
Some people don't like to consider the age pension as a safety net. I'm going to use my ex-husband as an example. He was very angry with me at one point after we separated, and he discovered he couldn't get an age pension, which I'm happy to say, if he'd been able to get an age pension, I would not have done my job well. But he just felt it was an entitlement. It's not. It's been asset and income tested since the 90s. Most people get angry that they only get a part pension, and yes, that's fair to a point, but it's also an understanding that we've got a significantly smaller taxpayer base right now than the boomers. And the boomers basically paid for less people than like their parents. There were less parents. After the war, there was a baby boom. And now there is actually a significant contraction in the number of births. So for people to be saying, oh, I should be entitled to it, and that, oh, there should be a fund set up that pays for all this, there wasn't, or there isn't. We can't rely on that type of thinking. We have to rely on the fact that it is simply a safety net for people who either missed out on having superannuation entitlements that will help pay for themselves in retirement. I've got 3 kids who are, well, they're not really kids. They're men who are in their 30s and early 40s, and they've got superannuation. They will probably never get any form of age pension simply because of either their superannuation or their future inheritances. Consider it as a safety net. It is simply meant to be that. And when they introduced the age pension way back in the 30s, effectively life expectancy was meant to be for a male at that point 64. The implementation age at that stage for an age pension payment for a male was 65. So the government really expected people to have been deceased before they were eligible for any form of support. Now we've got people living into their 90s. Let me tell you, if you're expecting to be living a lifestyle of champagne lifestyle on roughly $30,000 a year now, and I say it's roughly because by the time you get your minimum age pension and your maximum age pension and your 2 different lots of subsidies that go with that, you're going to be pulling up less than $30,000 a year, but I'm assuming you've got a little bit of super that you could maybe top it up with. $30,000 is basically just a minimum lifestyle. Doesn't allow for anything more than bare minimums.
Such a great conversation, Gayle. Now, for our international listeners wishing to join our Facebook group, the code word is yellow. And as always, this has been information only and not personal advice. Thank you so very much, Gayle.
Thank you, thank you, thank you.